In 2025, the US-China trade dispute erupts into a full-blown economic war. President Trump announces sweeping tariffs, raising duties on Chinese goods to 145%. Shockwaves ripple through global supply chains and financial markets. Beijing retaliates with its own tariffs, escalating the standoff. Diplomatic channels fall silent. Leaders refuse to speak. The world watches as these economic giants teeter on the edge, threatening global stability. For decades, China has been one of the largest foreign creditors to the United States. It has diligently recycled its massive trade surpluses into the safest financial asset on Earth, U.S. Treasury bonds. This relationship was once seen as a symbol of global economic symbiosis. China financed American spending, and America provided China with a secure place to park its immense wealth. As of early 2025, however, this relationship has soured. China remains the second largest foreign holder of U.S. debt, but its position is changing rapidly. This vast portfolio of American IOUs is no longer just a passive investment. It has become a powerful lever in the escalating trade war. The numbers are stark. Official data reveals a deliberate and sustained reduction in China's holdings. By April 2025, its ownership of U.S. Treasuries had plummeted to a 16-year low, a level not witnessed since 2009. The trend is undeniable. Figures from December 2024 showed holdings at $759 billion, a noticeable drop from earlier in the year. This is not a minor portfolio adjustment. It is a strategic retreat from U.S. dollar-denominated assets. Each $1 billion sold is a quiet but firm message sent from Beijing to Washington. The message is clear. Our financial support is not unconditional. It can be withdrawn. The term nuclear option is often used in political discourse to describe a last-resort catastrophic action. In the context of this economic war, it refers to China's theoretical ability to dump its massive holdings of U.S. Treasury bonds onto the open market. This is not a gradual sell-off. It is a rapid, large-scale liquidation designed to cause maximum disruption. The primary goal of such a move would be to flood the market with U.S. debt, causing the price of these bonds to plummet. As bond prices fall, their yields, or the interest rate the U.S. government must pay, would skyrocket. This would dramatically increase borrowing costs for the entire U.S. economy. The strategic logic behind this financial weapon is to inflict direct and immediate pain on the United States. A sudden spike in interest rates would make it more expensive for the U.S. government to finance its deficit. It would also ripple through the entire economy, raising the cost of mortgages for homeowners, car loans for consumers, and capital for businesses. The resulting economic slowdown, or even recession, could force the U.S. president to back down from the trade war. It is a high-risk, high-reward strategy. The goal is to create enough financial turmoil to gain a decisive advantage in negotiations, forcing Washington to the table on Beijing's terms. The abstract threat of China dumping its debt became frighteningly real in the spring of 2025. In the week leading up to April 11th, the market for U.S. government debt experienced a violent convulsion. The yield on the benchmark 10-year Treasury note, which is a key indicator for interest rates across the economy, recorded its largest single-week jump in at least 5 years. It spiked by a staggering 0.5%, climbing to around 4.5%. This was not a gentle drift. It was a sharp, painful shock to a market that is supposed to be the most stable and predictable in the world. The sudden move sent a wave of anxiety through Wall Street and financial centers globally. This volatility was particularly alarming because it came after a period where investors had been flocking to the safety of U.S. Treasuries. The escalating trade war had created so much uncertainty that the perceived security of government bonds was highly attractive. The sudden reversal of this trend, with yields spiking upwards, immediately fueled rampant speculation. The whispers in trading rooms and the headlines in financial news outlets all pointed to one culprit: a deliberate, coordinated sell-off by a major foreign holder. All eyes turned to Beijing. The market tremors felt suspiciously like the opening salvo of China's financial retaliation. As panic rippled through the markets, Washington officials scrambled to project an image of calm and control. On April 15, 2025, in the midst of the market turmoil, U.S. Treasury Secretary Scott Bessent publicly downplayed the threat. He delivered a terse and dismissive statement, asserting, "We just haven't seen that." This was a classic attempt to manage a crisis through denial. The official line from the U.S. government was that the yield spike was not the result of a hostile foreign power's actions. They insisted that the fundamentals of the U.S. economy were strong and that the Treasury market remained the safest and most liquid in the world. The message was clear: there is nothing to see here. This official narrative was supported by a chorus of analysts who offered alternative explanations for the market's behavior. They argued that a coordinated Chinese dump was unlikely, pointing to the self-inflicted damage it would cause. Instead, they suggested the yield spike could be the result of technical market factors. One popular theory was the unwinding of complex leveraged trades by large hedge funds. Another was that these funds were forced to sell their treasury holdings to meet margin calls in other volatile markets. These explanations painted a picture of a market correcting itself, rather than one under attack from a foreign adversary. China's recent sell-off of U.S. Treasuries signals a deeper, long-term strategy: de-dollarization. Beijing aims to reduce its dependence on the U.S. dollar, seeing it as a vulnerability. U.S. sanctions have shown how the dollar can be used as a weapon. In response, China's central bank is buying gold aggressively. Gold offers financial sovereignty, beyond the reach of sanctions or devaluation. The high-level drama of bond yields and central bank strategy is having a very real and damaging impact on the American people. The trade war, coupled with the new threat of financial instability, has sent a chill through U.S. households. Consumer confidence, the engine of the American economy, is sputtering. In March 2025, the Conference Board's closely watched index plummeted to a 12-year low. This was followed by an 11% drop in the University of Michigan's Consumer Sentiment Index in April. These are not just abstract statistics, they represent a tangible wave of anxiety washing over the country as ordinary Americans grow fearful about their financial futures. This anxiety is translating directly into reduced spending. Reports from across the country indicate that Americans are pulling back. They are delaying major purchases, cutting back on discretionary spending, and trying to save more. The reasons are clear. They are worried about their jobs in an economy threatened by tariffs, and they are worried about inflation as the cost of imported goods rises. The threat of a financial shock, with spiking interest rates making mortgages and loans more expensive, only adds to this climate of fear. The economic war with China is no longer a distant headline. Its consequences are being felt at the checkout counter and the kitchen table.